Good morning, everybody, and welcome to the latest in the series of More Kingston Smith COFA Breakfasts. I'm John Staniforth. I'm the head of professional firms at More Kingston Smith, and I'm joined today by Hannah Clegg, a manager in our professional firms team. Today's topic is the SRA Accounts Rules, getting them right, which is something that all law firms strive to do, but sadly some of them don't always achieve that. Given the updated SRA accounts rules became effective on the 25th of November 2019, it's quite a long time ago now, we did think this was an opportune time to have an update, given that for most law firms, they will be approaching their year end, whereby they will very shortly afterwards have their first SRA accounts rules audit for a full reporting period that will be covered by the new accounts rules. We have left some time at the end for questions and answers, but we would encourage all participants to please post your questions in the Q&A function in Zoom, and Hannah and I will try our very best to keep an eye on that as we proceed. So without further ado, I think we'll get started. So apologies for the plug, but we thought we're aware there's a number of people at today's COFA breakfast that haven't attended one of ours previously. So I thought we would just give you a little bit of insight into both More Kingston Smith and our professional firms team. So More Kingston Smith is one of the top 20 audit and accountancy firms. We are focused predominantly on owner managed businesses. Whilst we are within the top 20 in the accountancy age league tables, we're very different to most firms in that we're mainly based in London and the South East. So that's our marketplace. And when you actually compare More Kingston Smith to other firms in that region, we're actually in the top 10. So we're a lot larger in our own market than what the headline numbers suggest. Talking of headline numbers, we have currently 62 partners, and overall we have just over 600 people. We're also part of the More networks, both in the UK and globally. The More network has 609 offices, covering a total of 112 countries. So as part of the More global network, we do have a global coverage as well. Moving on to kind of professional firms, as I say, I'm the head of professional firms, so it's something very close to my heart. I'm pleased to say that professional firms is one of the largest sector groups within More Kingston Smith. We act for around 170 professional firm clients, of which around 70 currently are law firms. And literally within the legal sector, we see the whole spectrum of the legal world. Our clients range from sole practitioners through many mid-tier partnerships and LLPs, right up to one of the Magic Circle firms. Given that range, we have a number of clients that we obviously audit, but a number of clients that are below the audit threshold where we prepare their accounts. But on most of those clients, so around 50 of those 70 law firm clients, we also carry out their annual SRA Accounts Rules audit. So we like to think we're experts on the SRA Accounts Rules, and this is kind of our subject area. So I'll just move on. Just want to set out what we're going to cover on this morning's COFA breakfast. There's basically 4 areas in total. I'm going to start off with taking you through some of the common breaches that we see as reporting accountants in practice. I'm then going to move on to a few pointers on how law firms should set out their own guidelines and procedures in order to comply with the rules. At that point, Hannah will take over, and Hannah will be going through the kind of difficult subject area for reporting accountants, where we have to apply quite a bit of judgment in terms of what constitutes a reportable breach. Similarly, the same judgment has to be made, of course, by the COFA, because there is also, as well as reporting accountants having to report significant breaches to the SRA through our accountants report, the AR1, there's a responsibility on the COFA to report material breaches as they arise. So it's a real judgment area for both COFAs and reporting accountants. And then, as I said, we'll finish off with some questions and discussion. So moving on to common breaches. The first one that we're going to cover is not completing a three-way bank reconciliation every 5 weeks. I think from my experience, I would say this is probably at the moment, probably the second most common breach of the SRA accounts rules that we see in practice. So for those of you who like rules, I know there's not as many rules as there used to be in the SRA accounts rules. So they fell from 52 in the 2011 rules to just 13 in the 2019 version, the latest set of rules that law firms adhere to. The relevant rule here is 8.3. So what Rule 8.3 says is that law firms must at least once every 5 weeks carry out a three-way reconciliation for all their client accounts. It is all their client accounts. And what we mean by a three-way reconciliation is comparing the bank statement to the client cash book balance and also to a listing of client ledger balances. So where do law firms go wrong in this area? Two main ways, really. The first one is not actually doing a proper three-way reconciliation and just carrying out the normal, if I can call it that, so the normal kind of bank reconciliation, which is where you just compare the bank statement to the cash book and show any reconciling items, which are typically unpresented checks and maybe the odd outstanding lodgement. So there are still a number of firms that we come across that that are still doing two-way bank reconciliations every month, but they fall foul of the rules because it needs to be a three-way reconciliation. Sometimes we get the argument thrown back at us that, well, our system, our solicitors software, doesn't allow, it has a control in it whereby the client cash book will always agree to list the client ledger balances. So it automatically reconciles, fine. But the rules are very clear that you have to have that three-way, those three lines set out on your client account reconciliation. The other area where that rule tends to be breached is I kind of touched on it earlier or hinted at it earlier, which is that sometimes firms forget to do it for all their client accounts. The general client account doesn't tend to get missed. If anything, there might be the odd designated deposit account, which is not used very frequently and just has interest accruing on the balance. Again, as I say, the rules are very clear. It's all client accounts. So it should be all general client accounts and all designated deposit accounts and foreign currency client accounts as well need to be covered by these three-way reconciliations that are done every 5 weeks. In practice, that every 5 weeks causes a little bit of confusion. When we're checking it as a part of our reporting accountant work, what we do is, because most law firms tend to prepare their client account recs as at the end of a month, as long as that three-way reconciliation is completed by the end of the following month. So, for example, as long as the 31st of March 21 bank rec is completed by the end of April, then that's clearly within the 5 weeks. It's within 5 weeks of when it fell due. So that's fine, that's compliant with the rules. Strictly speaking, you can have a few more days, as the notes say. You can have until the 5th of May to complete the rec. But in our experience, most firms do it within that month anyway. So that's absolutely fine. In terms of kind of seriousness, this is quite a serious rule to breach. Because, as I said earlier, the SRA accounts rules were boiled down from a huge number of 52 down to just 13. So what that means is the SRA only really retained what they perceive as the vital rules. So the fact that the three-way reconciliation requirement every 5 weeks was retained means that the SRA see that as really quite fundamental. And the reason for that is the best mechanism by which law firms can identify if there's any shortfall on their client account. So without doing that three-way reconciliation every 5 weeks, there's an argument that a law firm may not be aware of a shortfall or black hole in their client account, because there's no kind of check and balance in place to make sure that's the case. We'll move on to the second breach area, and I think this is probably these days the single most common rule that we see breached in practice. So again, for those people that like their rule numbers, in the new rules, it's rule 2.5, and it requires funds to be returned to the client as soon as there is no longer any proper reason to hold those funds. So rule 2.5 is quite a bit different to the equivalent rule in the 2011 accounts rules. In the 2011 accounts rules, it said that client money balances should be returned to the client on the conclusion or substantial conclusion of the matter, unless there's a good reason to hold on to the money. And then if you are holding on to the client money, you should write to your client regularly to keep them informed of the balance and the reason for retention. And the rules actually say at least annually. In contrast, the 2019 rules are not quite as prescriptive, like they are in most areas. They're not quite as prescriptive. So rule 2.5 still has that requirement that you should return funds as clearly as possible, but it's not tightly defined. It just says that funds should be returned to the client as soon as there's no longer any proper reason to hold those funds. And I think it also refers to the word promptly, which we'll come on to later on. So whilst the rules don't dictate that if you're not returning funds at the end of the matter, there's no strict requirement to write to the client periodically, we do feel that's best practice to do that. And so that's what we tend to recommend to our law firm clients. And this is one of those areas that we'll touch on later, in that this is one of the areas where law firms should probably have their own policy within their SRA Accounts Rules Manual or handbook. And so that's the important one to cover off. But residual balances, as they're frequently called, is a very, very common area of difficulty for law firms. Frequently, it's because of mergers. Firms might have taken over other firms who, so effectively the successor practice inherits the historical issues to do with residual balances of the predecessor firm. And the important thing is how that firm deals with those residual balances. It doesn't just basically leave them there. They do actively try to return them to the clients, and where they can't, ultimately they could give them to charity. Obviously, if it's below £500, it's relatively straightforward. If it's more than £500, it does require SRA approval. So I've got a question here. What is the normal or recommended timeframe to return funds after the completion of the matter? If it's okay, we'll cover that question later on, because one of the areas that Hannah's going to cover actually covers that specific area. So we'll pick that one up in a short while. Moving on, the third area, and perhaps it's a bit of a misnomer to call this a common breach, but it is certainly one we've come across in practice. So rule, again, people that like their rules, the relevant rule here is 3.2. And 3.2 again is one of those rules that's pretty much been copied across from the old version of the rules. So rule 3.2 makes it very clear that all client bank accounts need to be in the name of the firm, firstly, but they must also include the word client in full in the title. And the reason for that is to make sure that it's very clearly identified as a trust account, so it's money you're holding on behalf of clients. So occasionally we have come across some client accounts that are still in the name of either a sole trader or a partnership that has subsequently converted to an LLP. We still find some firms that have their client accounts held in the kind of name of the old firm, which is obviously not in compliance with the rules. But possibly the area that's breached more is not having the word client in full in the title. I think it's probably fair to say that banks have got better at making sure they do include the word client in full in the title of bank account. But there are still occasions where we come across that requirement being missed. So what our recommendation would be is for any law firms, if you're opening any new client accounts, the first time you get sent the checkbook, if it's a client account you've got a checkbook on, or failing that, the very first time you get a bank statement, whether it's a paper bank statement or an online statement, make sure you do check the name of the account title and make sure it does have the word client in full. Banks sometimes miss the word client out completely, or they put an abbreviation of the word client, sometimes because they're limited to the number of characters on the account title. But the one word that they shouldn't shorten is client, and chances are that's the word that does get shortened, unfortunately. One specific example, we did have one of our clients that moved banks. They moved from one high street bank to the other, and we identified on the SRA Accounts Rules audit that they didn't have the word client in their account title. The bank then told them that had been rectified, and when we went in the following year, it turned out that the bank manager had purely changed the addressee on the bank statement, and the account title was still missing the word client. So it is an area to be very careful on. Check it in the first place, check the bank, set up the bank account in the right name, including the word client, but also if they've got it wrong, make sure they do rectify it correctly as well. We'll move on to the fourth area that we see as a common breach, and this used to be called the 14-day rule. Everybody used to know it as the 14-day rule in the 2011 rules. And what that rule stated was that once a law firm has raised a fee note and sent it, and crucially sent it out to their client, that kind of starts a clock ticking. And at that point, from that point, you have 14 days in order to transfer the money in respect of those costs over from client account to office account. So at the point that you send your bill out to your client, that's the point at which the money held in client account becomes earmarked. And from that point on, you have 14 days to transfer it over to the office account. There is no equivalent rule in the SRA Accounts Rules, the ones that became effective in 2019, but it is covered by the area of the rules that say that all transfers should be done promptly. So this is an area where law firms will have to set out their own internal rule in that area, the number of days that they will set between which the bill is sent out to the client and the money is transferred over to the office account. Now, obviously, in terms of cash flow, there's particularly these days, during the pandemic, there's a big advantage or a big benefit for firms to make the number of days as small as possible. But at the same time, you don't want to make it so quick that you could easily breach your own rule or your own guideline. So in practice, some firms are just sticking with the 14-day rule because they're used to that, and they don't need to vary, and their legal cashiers don't need to learn something new. But a number of other firms are actually going for a shorter time frame, so something like 3 or 5 days is quite common. But it's very important that firms have their own policy in this area. And as part of our SRA Accounts Rules audits, going forward, we will be asking firms what their policy is in this area as part of our work. So it should definitely be included in your SRA Accounts Rules handbook. Before I move on to the next area, because 4 seems like a funny number, I'm just going to throw an extra one in, which aren't in the slides, I'm afraid. I didn't want to put this in the slides because it's not a common breach as such, but it's a very, very important rule breach. So the rule I'm talking about here is 3.3. And this is the rule that, again, is one of the rules that got retained from the 2011 rules. And it's all about banking facilities. So what rule 3.3 says is that you do not use your client account to provide banking facilities to either clients or a third party. As I say, it's not very common in practice, but where I have come across it, it's very, very serious. So I won't give too many details away, but I sometimes do expert witness work. And about a decade ago, I did some expert witness work for a City of London-based law firm where they did an SRA inspection, and they fell foul of this rule. And that was because going through their client ledger for one particular client was things like school fees. Now, this wasn't any matter where school fees should be coming out of client account. It was actually on the client ledger of something to do with the sale of a business. In terms of that rule, it's very serious. Very rarely breached in practice, but if you do breach it, it's very, very serious because the SRA take it very seriously. Because basically providing a banking facility is outlawed. My advice in this area is always to law firms is whenever you're receiving money into client account and you're paying money out of client account, just ask yourself the question, does this relate to this legal matter? Is the receipt and the payment out strictly relating to that legal matter? If it is, there's no issue, it's absolutely fine. If it's the case that no, really that's not directly related to that particular legal case, then you've probably breached this rule of providing a banking facility. So it's one to be very careful of. We'll move on now to the second area, which, as you'll have gleaned from what I've said already in terms of the common breaches, because the SRA have boiled the rules down from 52 to 13, they've gone from a very strict black and white rules-based approach to a more principles-based approach. And the consequence of that is that means that, all law firms will really need to set out their own guidelines and procedures in order to comply with those rules. And we're recommending that all our law firm clients do that, set that out formally in an SRA Accounts Rules Manual or policy document or handbook. So if we just move on to the first area in this, I think it's fair to say in our experience that an awful lot of firms, the vast majority of firms, have largely continued to comply with the 2011 rules because that's what they knew. Firms very much like the clarity of the old rules because they were very much black and white and not many areas of grey. And also the legal cashiers were very familiar with a set of rules. So most firms have just not really changed much at all. The SRA have said that if firms continue to apply the old rules, then they wouldn't actually breach the new rules. The only thing to be careful of is that there are one or two areas where the rules have explicitly changed. So you just need to make sure that if you're carrying forward complying with the 2011 rules, just be aware of where the 19 rules are slightly different and make sure that your internal procedures are set to those new rules. So as time has passed, firms are having to set their own policies and procedures. Areas that we've discussed today already, which kind of overlap with the notes we've covered already, would be transferring funds earmarked for fees to the office accounts. That's very clearly an area where a law firm needs to set a deadline by which once money's earmarked that's in the client account, the number of days you will take to transfer it over to office account. And similarly, firms will need to have their own procedures for informing clients of residual balances held in the client account. That's an absolute must. Other areas where firms have considered setting their own policies, not surprisingly, include a definition of prompt. Prompt comes up in quite a lot of areas in the rules, but rather annoyingly, it's not defined anywhere in the SRA Accounts Rules. So what that means is that law firms have to make their own interpretation of the word prompt or promptly. A couple of areas where we'd recommend that firms set out what prompt means for them is transferring funds to the office account promptly. What does it mean for them? And also returning residual balances promptly, i.e. what's the time frame on that? Both need to be done promptly in the rules, but as I say, the definition of prompt will likely differ from firm to firm. Similarly, when paying residual balances to charity, firms will have to set out what constitutes reasonable steps in accordance with the SRA's prescribed circumstances. The use of third-party managed accounts and to which matters they might be suitable for is another area. In practice, I have to say that we're still finding that the take-up of third-party managed accounts, or TPMAs for short, is relatively limited. Having said that, we have come across one or two new entrants to the market, probably more ABSs, that are more seriously considering the use of TPMAs. So if that's something that your firm is planning on doing, again, you need a policy set out as to when you think that you will use a TPMA. How to document that the COFA has reviewed and where necessary taken action in respect to residual balances and also trivial breaches reported to them is another area that we'd recommend that each law firm has their own procedure set out. So just to finish off in terms of guidelines and procedures, the key consideration when setting out your own policies, as ever, is documentation. Documentation. So the kind of things you need to be thinking of is, why is this particular policy suitable for your firm and its clients? Following on from that, is it suitable? Okay, and then will it apply to all clients or just certain types of transaction is another consideration. You should always document why you feel there will be no loss to the client, particularly if you're moving away from the 2011 rules. So the SRA says no reason why firms can't move away from the 2011 rules, but if you are, we would recommend that a firm documents why you believe that won't lead to a loss to a client or increase the risk of a loss to a client. And a final area would be, how frequently will each policy be reviewed to ensure it's still fit for purpose? So that covers what I was planning on covering today, and I'm now going to hand over to Hannah, who's going to talk about what constitutes a reportable breach.
Hello. Right, as John mentioned earlier, although we sometimes have to submit qualified accountants reports to the SRA, there's also very much the onus on the COFA that when they have breaches reported to them by the fee earners in their firm, that they need to consider whether or not that breach is serious enough to warrant being reported to the SRA. Historically, under the 2011 rules, the SRA did publish some guidance on what might constitute a significant breach that they would expect to hear about. And you won't be surprised to hear that many of those cover the things that John's already talked about, such as a significant or unreplaced shortfall on the client account would always need to be reported, although the things to be considered there are the significance of the balance. How big a balance was it? If it's only maybe £100 or so, and it was rectified and put back promptly, then maybe that wouldn't need to be reported. But again, documentation is key, and putting down your thinking as to why you reached the decision that you did would be key there. Actual or suspected fraud, again, always something that the SRA would like to hear about and should be reported straight away. The third one, again, just brings home how important this point is to the SRA, that if three-way client account bank reconciliations are not being carried out, the SRA do consider that a significant breach. And so it's really important that firms complete these reconciliations in the proper manner and that they're done regularly. And then finally, as John said before, using the client account as a banking facility. However, when the new rules came out, or shortly before they came out, the SRA did issue some further guidance as the rules became more principles based and less very clear cut on what was or wasn't a breach. And they actually issued a very interesting document. Now, it was aimed at the likes of John and I, and it's called Planning for and Completing an Accountant's Report. But what's useful about this document is that it goes through several key areas and it sets out what it thinks are above adequate, adequate and below adequate control systems and procedures that we should be looking for when we're doing our work. And therefore, we feel it'd actually be useful for the COFAs to be reading this, because it sets out to them what the SRA are looking for when considering their controls and systems. And therefore, you could maybe use this as a guideline to when you're putting together your manuals and your procedures. The guidance can be found at the link there. It's not very long, but it is, like I say, a very, very useful document. So this is just some of the extracts. So talking about the residual balances, this links back to the question that we had earlier. So as you can see there, the SRA define an adequate period for returning client balances at about 90 days. I do have some clients that put it as slightly longer, although not much. But I think most importantly, the thing is that there is a procedure in place. It's not too long, and that there is a procedure to regularly review the client residual balances. Now, as you can see here, the SRA say that above adequate would be for essentially there to be no residual balances, and that at any one time they would be rare. I have to say, I think that's slightly wishful thinking on the part of the SRA. Every firm has residual balances. I'm not sure of any that would say they are rare. But where some firms risk having a problem is that where there's either no system in place for dealing with the residual balances, or it doesn't effectively clear them down. So I know some firms, they issue reports to all the fee earners and they say, well, we've told them about it. But unfortunately, I'm afraid those fee earners also need to be nudged to actually make sure that they're taking action to clear those balances. Unfortunately, it's all very easy when you have lots of clients emailing you with demands on your time for this to slip down the bottom of the to-do list. And clearly this is a key area for the SRA and it needs to be kept upon, because unfortunately what would happen otherwise is that you risk coming into this significant breach bit where it says that they're common. And if a firm is deemed to have a common or a problem with residual breaches and they become common, then there is a risk that they may need to be qualified. So as I say, most firms we act for have residual balances. What we would suggest is that where the balance is under £500, the firm follows the procedures that it's put in place to pay these balances away to charity. And where they're over £500, the firm take action to write to the SRA and get permission to get it paid away. But before you can do that, you will need to show that you've taken reasonable steps to return the funds. So what might those reasonable steps look like? Now, the SRA don't set out any rules in this per se, but they did issue guidance that said when a firm is setting its own procedure in respect of residual balances, they should take into account the size of the balance, the age of the balance, and the information that you hold about the client. So do you have an email address for them, or do you only have a home correspondence address? Of course, email addresses tend to move around with people. They tend not to change too frequently, whereas a residential address can change. Where I've seen firms deal with this point quite nicely is where they put this into more of like a table format. So they've split out the balances by size, and then between the managing board, they have set out what they think is reasonable steps to take. So it may be that if you have a balance of under £100, say, that you send 3 emails to the client. The last email will say that I'm afraid that if I don't hear back from you within a period, say 30 days from now, then we will pay this balance to charity. And then when it comes to the cashier to make that payment, if the fee earner can present them with the 3 emails and said, I haven't heard anything back, then you can show that you have complied with your firm's guidelines in this respect. Of course, the greater the balance, the more steps that you will need to take, up to the point where you may need to consider appointing a tracing agent to locate your client. One of the other examples that the SRA gave was withdrawals from a client account. Now, this isn't an area that we tend to find too many breaches on. They tend to be already have been picked up by the internal controls, because most of our clients do have a procedure in place, although it may sometimes fall under the adequate box where it's not necessarily formally documented in a manual. But normally the cashiers are very clear on the signatories that can make payments from the client account and so on, and they adhere to them. The item I really wanted to highlight here, especially in light of the situation that we're currently in with the lockdown, is that instruction received from the fee earner by email is not considered a secure way of receiving an instruction to make a payment on the client account. As we know, emails are quite easy to hack in this day and age. So if you are, or if your cashiers are accepting confirmation to make a payment in this way, you may need to have a rethink about your procedure. Lots of software these days will allow for firms to have a workflow that goes through the system, and so long as your software is accessed by password control, then you can be reasonably confident that the instruction is coming from the person that it's saying it is. Alternatively, I know some firms that where email confirmation comes in, just because it's easier to set out the amounts and the payment details, they then do just get verbal confirmation from the fee earner on the telephone that this is the correct instruction and they'd like the payment to be made. Somewhere that the SRA haven't really asked firms to look at before, but is clearly something that they're looking at more now, is the general IT control systems that firms have in place. Again, it comes back to having your system being fully documented. They do, however, say that the controls you have in place should be commensurate to the size of your firm, and that what may not be suitable for a small firm or a big firm may not be suitable for a smaller firm. So this is where there is that level of subjectivity in there. But again, I think things like having password protection on software, people not sharing the same password so that you can clearly see who has made actions within the system is something that should definitely be done. Having firewalls and making sure that leavers are removed from the system as soon as possible after leaving are areas that should always be in place, and controls that should always be in place. This area here, general compliance with the rules, I thought is quite interesting and links back to a lot of what John has been talking about earlier. It talks about the COFA having reviewed the bank reconciliation on a regular basis, but again, picks up on other areas that the COFA must review the breaches register on a regular basis. And in doing so, the COFA is looking for not just evidence of significant breaches that may not have been flagged to them immediately, because I appreciate, especially in larger firms, what may happen is that the fee earner may report it to a cashier who then normally reports it to the COFA, but also looking for a pattern of breaches. And that can either be on an individual fee earner, the same name keeps cropping up, or that the same rule keeps getting breached, whether that's residual balances or whether funds not being transferred from the client account within 14 days. And that where these breaches are reviewed, that there is challenge, if necessary, by the COFA, and what action was taken and what's being done to remedy this going forward. So the COFA having a greater role of oversight over the firm is definitely something that the SRA are moving towards. An item that I think is quite interesting here is the fourth bullet point under the below adequate box, which is where the same reconciling item, other than an unpresented check, appears on 2 consecutive monthly bank reconciliations, and it has not been challenged by the COFA. So this is something that we do see occasionally. These kind of reconciling items are almost always a breach. Therefore, it's key that the COFA considers these and makes sure that they are remedied as soon as possible. The question then becomes, how do you document this? And again, this will depend on the size of your firm. What I've suggested for some of my smaller firms is that we have reworked their reconciliation cover sheet. So at the top, it may have their 5-weekly or their 3-way reconciliation. And then what we've got the cashier to do is they start appending the breach register to the back of that schedule. And then there's a little sign off at the bottom on the main cover sheet that says, I have reviewed the breaches register and I have not noted anything of note, or I have noticed this and I have done this about it. Similarly, they've started listing out the residual balances that the COFA needs to look at. And then there can be a section for the COFA to say, I'm aware of this balance, we are retaining these funds because, or I have emailed X fee earner and they are going to reach out to the client with a view to returning these funds to them. So that to me, for a much smaller firm, is a nice, neat way of documenting this. I appreciate some larger firms may have risk committees or similar where these items are discussed. And in those instances, they should be minuted what action has been taken. And that brings us nicely to the end. If anyone has any questions, if you could please put them in the Q&A. We haven't had any more.
There is one question, Hannah.
Oh, okay, sorry.
I'll read it out to you, given that it's an area that you covered. So, can you have in your terms of business any residual balances less than £25 is donated to charity at the end of the matter? Most partners don't want to contact clients with admin, and most clients don't respond to small requests for return of funds. So do you want to answer that one?
I think that's probably a decision for the firm to make. If you feel that that is appropriate and you can document why you feel that that is appropriate and there would be no loss to the client, then that would possibly be okay. It is a very small amount of money. So probably what I would really suggest, though, is that you stress to fee earners that the balance is returned immediately at the completion of the matter, and that would prevent these balances arising. But I think, yes, if the balance of under £25 has been sitting there for more than a year or so, that potentially is, I can understand why you wouldn't want to incur chargeable time doing that kind of admin.
Yeah, I think I'd be inclined to agree with you, Hannah. Probably a little bit harsh for me to throw it on you and then coming afterwards, but hey, that's the partner's role. Yeah, I think I'd be inclined to agree. I don't see any reason why firms can't have that in their terms of business, because at the end of the day, less than £25 is probably a kind of de minimis level. I don't think we'll ever kind of qualify our accountant's report on the basis that a law firm has paid away £25 to charity without writing to the client first, because I don't think you could argue that's a kind of a significant loss to any client. And having said that, I think kind of I would maybe separate it out into two different types of residual balances. I think it's the case that the residual balance we're talking about is one that you don't know who the rightful owner is. I can very much see a strong argument that it's not worth the cost of trying to research into, looking back into history, who the rightful owner is. And there's an argument there that, again, the cost of, like, say, for instance, getting a tracing agent would be excessive compared to the balance. So I think where you don't know the rightful owner of the balance, I think, yeah, it's pretty much a clear-cut thing that you can give balance of less than £25 to charity. I think where it's very clear who the money is owed to, so you know who the client is based on the name on the client ledger, and it's very clear from the ledger that that's money due back to that client. I think my preference, and it is just a personal preference, my preference would be to have a process, which I see a lot of firms, particularly our larger firms, doing, which is where they send just one email out to that client and say, we're holding a balance of, say, £23.50 on our client's account. We've held it for this amount of time. It relates to this matter. If we don't hear from you within X amount of time, that might be within a month or within 2 months, then we will pay that amount to charity. I think that's probably a more comfortable area to be in, because then you have got a more clear-cut policy, and you are actually making an attempt to return that money to the client that you know. But that would just be a personal preference. I wouldn't change what Hannah said, in that I don't think the SRA would have a problem with that being a policy in a firm's terms of business. We've had a few more questions come up. I think there's a couple that are very similar. Are you able to share a recording of your presentation or slides with attendees, please? And are you sending out any notes? Yeah, I was going to cover that. I should have covered that at the beginning, really. Apologies. I decided to cover it at the end instead. Everybody attending this COFA breakfast will receive an email within the next day, which will have a number of things attached to it. It will have a link to the recording of the webinar. So if I in particular spoke too quickly at any point and you missed something, you'll be able to play it back. Similarly, there will be a copy of the slides attached to the email. And finally, there will be a feedback form as well. So we would really kind of encourage people to complete the feedback. We'd be interested to hear what people have to say. And in particular, we'd be interested for any ideas of future topics that you'd like to cover. We'd like us to cover on these COFA breakfasts. And you never know, we might just be able to do the next COFA breakfast in person. We all live in hope of that, I think. Is there any more questions that we've missed?
Yes, there's one more question, and it's interesting actually. The question is, can you tell your view on whether holding rent deposits on behalf of commercial clients constitutes acting like a bank? And it's quite interesting because I did have that same question come up on an SRA review I did about a year to 18 months ago. And I think ultimately it kind of swings on a few things. It will depend on what the actual documentation in relation to the lease says. So the lease may say that the deposit will be held and it will be held in the firm XYZ's client account. I think if the lease says that, then that gives you grounds for potentially continuing to hold it. The other point was, is it an ongoing legal matter? Is there still a reason to be holding those funds on client account? I actually spoke to the SRA's ethics help desk on this, and they felt that just the fact that your firm had helped put the lease in place was not an ongoing legal matter, and that the rent deposit should be held elsewhere and not on client account. So yes, the SRA's view was that unless the underlying documentation said it should be held in your client account, or it was an ongoing legal matter, that yes, that did constitute acting as a bank, and that the deposit should be held elsewhere by the client or as otherwise specified in the lease.
Yeah, I would. I mean, funny thing is, I've been a partner at Kingston Smith for 18 years, and I think I've carried out SRA Accounts Rules reviews for most of that time. And I'd never come across this point until a couple of years ago, and then we had it come up on 2 law firm clients close together. So it was obviously a bit of a kind of hot topic in the area of the SRA Accounts Rules. And as a result, the SRA did issue some guidance, which Hannah's quite rightly referred to. I think my overall advice would be that it's clearly an SRA, it's clearly an area where the SRA have got their own interpretation. And I think it's one that law firms have to be very careful of. So if you can at all, when you're drafting rent deeds and lease agreements, if you can word it such that the landlord head holds the deposit rather than the law firm, I do think that would be preferable. I think that makes it more clear cut and avoids the law firm having any issues with the SRA, because it is one where the SRA seem to be going down the angle that they think too many law firms are holding rent deposits on behalf of clients. So that would be my recommendation. Okay, I think that covers all the questions that we've had in the Q&A function. Some really excellent questions there. So thank you very much for the audience members that posted those questions. I think we've exhausted all the questions. So thank you very much for your time. As I said, an email will come out in the next 24 hours. So please do keep an eye out for that. And please do complete your suggestions for any topics, any kind of burning issues that you as COFAs or members of accounts departments in law firms would really like us to cover off. And we'll try our best to put those on in future COFA breakfasts. And as I say, hopefully we'll be able to do one with an actual breakfast, which would be good, as opposed to people having to eat their breakfast and then join this session. So thank you very much, everybody, for your time, and have a good day.